what is perhaps an ongoing and a bit less reported story. JP started accumulating all this silver. In fact, now, as we know, JP Morgan has the most significant physical silver position of all time. Does JP know that we don't?
Hello, and welcome back to the channel. Have you ever imagined what would happen if the financial institution that you trust ends up committing fraud with your money? Well, it's not a joke anymore because it has become a fact of life. We are not saying all banks do this, however, some of the biggest financial institutions are no strangers to fraud. In today's video, we are about to discuss some of the biggest frauds committed by banks and see how they get away with their frauds. But before you learn about the bank's biggest frauds, pay attention to the big red subscription button. As soon as you click it, you will be taken to the wealthy side, the life you deserve, where you'll find hundreds of videos. These videos contain the answers to almost any question you may have. There are also daily updates, so if you want to stay tuned, remember to turn on notifications. Number 1. Gold and silver rigging. In 1974, the future markets started trading in the gold and silver markets. Future contracts are primarily an agreement between two parties to trade an asset at an agreed date and price. As time went by, more futures contracts were made at the whim of both parties in this case. This essentially enhances the virtual supply of gold and silver, while, in reality, new metal was not being mined. Also, the prices and the amount of gold and silver traded had a major impact on the underlying supply of metals. As anyone can imagine, the system was ripe for abuse, and by 2018, more gold and silver were traded in a few days than were mined. And in the same year, just 34 tons of registered gold stocks were delivered through future contracts. Yet, 260,000 tons of gold was traded on the COMEX, which is more gold than has ever been mined and 86 times the annual gold mining supply. JP Morgan manipulated the gold and silver prices between 2008 and 2016. In this case, they were doing something known as spoofing, which is meant to convey a false sense of demand that they were not generating. This approach aimed to move market prices in such a way that can benefit the bank financially. Also, for a long period, this idea was portrayed as a conspiracy theory to summon the financial industry. Andrew Maguire, the financial whistleblower, reported in an interview with CNBC in April 2013 about JP Morgan's mysterious traders. As they wait until many of the big banks get close, and then they use a different market known as the COMEX to trade virtual silver anonymously. Not only that, but they have also utilized algorithms to bounce in and out of the futures market in no time, which is around 400 contracts in just 1 second. Well, the thing is, every contract represents 5,000 troy ounces of silver. During Maguire's interview, he also described how a mystery seller had sold contracts for $45,000 per contract while earning $85,000 per contract, equaling $3.6 billion in profits. But these types of unusual market movements were not that surprising, because the difference between the actual amount of physical gold that is present versus the digital gold traded on the futures markets has now become so huge. As currently, there are hundreds of claims of ownership on every ounce of gold. In simple words, for every ounce of gold bought and sold in the futures market, all of the traders believe they have a claim to the metal. However, the problem is that 100 more traders think the same thing as well. Therefore, let's just hope everybody doesn't want their gold all at once. Well, in the year 2019, JP Morgan was accused of being a criminal enterprise by a federal prosecutor for the rigging of the gold and silver market. Along with that, in September 2020, the Justice Department issued a $920 million fine for rigging, but real profits were in trillions of dollars. So, this practice is still conducted today, and fines are nothing more than the cost of doing business. Number 2. Wells Fargo scandal.
If they really didn't know, then that tells me this is a bank that is simply too big to manage. Either they knew or they didn't know. In which case, how can you run a giant multinational bank?
Relentless pressure, unrealistic sales targets, a culture built on selling as many products to customers as possible.
At number 2, we have the Wells Fargo Bank, and the scandal is about creating fake accounts. The third largest bank in the United States demolished its status in just one major disaster. This begins when the executives of the bank wanted their staff to meet some major targets in the business of financial products. These products include things such as credit cards or mortgages. Setting the goal to sell more financial products, the executives made it necessary for the employees to meet those targets to get bonuses or promotions. On the other hand, if they were unable to meet their targets, faced nonstop pressure and even the warning of termination. So, the thing is, the average number of products held by a customer is one way retail banks measure success. For being successful, the employees at Wells Fargo started creating millions of savings and checking accounts for customers without their acknowledgement or approval. The reason behind this is they were looking to sell multiple products to the same customers. As you know, if a customer has a checking account, then he might also get a credit card that he doesn't even want. And the bank branch staff engaged in inappropriate activities to achieve the sales goal described by the company. A quick reminder, if you've enjoyed the video so far, consider subscribing, as we frequently upload such informative and educational videos. Let's continue. They begin to use their contact information on forms to stop the customers from discovering the scam. Also, the employees were accused of creating fake checking and savings accounts by withdrawing money from the current existing accounts and transferring them to new accounts. They have done this by setting the customer's PINs to 4 zeros, and ultimately, the bankers then get complete control of their customers' accounts without them knowing. In 2011, the Wall Street Journal suspected something sketchy and reported a story of illegal practices. However, nobody showed interest in it. Not just that, one more article was published by the Los Angeles Times in 2013. This article essentially focuses on the extreme pressure on banks and managers and individual bankers to come up with more unexpected sales. Still, it doesn't get much attention. However, in the end, most of the customers noticed something problematic as they raised questions about the unusual fees on their accounts. Eventually, the extreme influx of complaints started getting the attention of the regulatory agencies. And this fraud started coming to light in 2016 when a group of regulatory agencies from the government fined the bank a combined $185 million. It was also reported that, even knowing there were some unbelievable numbers or some fishy targets, the executives didn't even do anything. But afterward, Wells Fargo faced civil and criminal lawsuits and paid out more than $2.7 billion. And the chief executive, John Stumpf of Wells Fargo, was forced to resign. In the end, the bank made over 3.5 million fraudulent accounts, but that was in place of a hard-earned reputation for short-term profits. Number 3. LIBOR rigging.
The allegation is that Barclays manipulated the interest rate it reported that it could borrow at to this LIBOR committee.
This one might be the biggest scandal of all. As you know, interest rates are a crucial part of the economy. But let's assume the interest rate of all the loans, including student, corporate loans, and mortgages, are controlled by one single mechanism. This mechanism was made, and it was altered with fraudulent activities. Well, this mechanism is known as the LIBOR rate. The LIBOR scandal was extremely big, and it worked as all the banks had to estimate how much interest they would have to pay to borrow cash. The average of those rates then served as the LIBOR rate. Overall, LIBOR underpins $350 trillion of value based on derivatives, so manipulating LIBOR inherently causes a cascade of mispriced financial assets throughout the whole global financial system. The LIBOR was considered a total assessment of the health of the financial system. Because if the banks were confident about things, they report a low interest number, or if the banks examine the risk and feel less confident, they report a high interest rate number. The major problem with that approach was that the bank's interest rate estimates were used to determine the LIBOR interest rate. These banks do not have to borrow and lend at the same rate mentioned in the LIBOR because they merely have to tell the regulators that they would do so. But practically, they would be doing this at totally different rates to grab profit on the difference. In addition, they saw that they could form a cartel and rig the LIBOR rate to benefit themselves. They joined and continuously tampered with the numbers, and they were offering inflated or deflated interest rates to regulators for many years. Sadly, the fraud also affected corporations and individuals horribly who had loans based on the LIBOR rate. In turn, banks made a lot of money from it. Like Citigroup had interest rate swaps of a notional value of $14.2 trillion. and Bank of America had $49.7 trillion. These numbers are whopping, and only a little change in the LIBOR rate was capable of making cash for them in bulk. This affected many people and also other stakeholders. Just to give you an idea of the home mortgages, the homeowners in the U.S. filed a class action lawsuit in October 2012. It was against the biggest 12 banks that were tampering with the numbers and eventually making the mortgage payment way more expensive than ever before. Several banks were fined, but the fines offered were nothing compared to the amounts they made in this huge scam. So, in a nutshell, knowing that banks are doing fraud and rigging their way at the expense of others is not something new. However, seeing the extent that some banks or giant financial institutions go is whopping. Whether it's about rigging interest rates or creating fake accounts, it makes everyone left wondering. Well, there are many other frauds that we didn't even talk about. That includes the rigging of the currency exchange market that contains 11 banks, or the derivative bets that went wrong and made the housing crisis in the United States turn into a global financial issue. By knowing that we know that there are plenty of these frauds around us, but we hope justice can be served over time. As an individual, what we can do if we get stuck in these scams is have a diversified portfolio. In this way, such scams are not going to affect you much. Instead, they're going to be helpful for your financial freedom. Let us know your thoughts in the comments section. We would love to hear from you. Did you enjoy the video? Please hit the subscribe button, like, share, and comment.